Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at my dividend growth portfolio that now has a value of over $109,000. And I'm going to give you an update on how the portfolio performed throughout June 2021. We're going to take a look at my monthly dividend income, the capital appreciation on my stocks, and the latest buys and sells I've made over the past 30 days. And if you're new to the channel, I'm the Gen Z investor, and I'm building up a dividend stock portfolio made up of around 27 blue chip companies from pretty much every sector of the market in order to collect some growing cash flow every single quarter to one day achieve financial freedom. The overall goal of this portfolio is to build up a growing stream of monthly passive income so that one day I can retire and let the passive income that these dividend stocks provide me pay for my lifestyle and I can become truly financially independent. So right now the total portfolio value sits just below $110,000, and as I continue to contribute capital more and more into the portfolio, I reinvest all my dividends, this number will continue to grow and compound for many decades to come. So before we take a look at my portfolio in detail, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. And of course, we track the progress of my personal financial freedom portfolio as well. And I share with you every company that I buy, the overall progress of the portfolio in total, and all the good and bad I make on my investing journey. So if we jump over to Simply Safe Dividends, this is my portfolio overview. Like we saw, just below $110,000 in total portfolio value, and my annual dividend income sits at $2,149 with a current portfolio yield just below 2%. And my yield on cost has now grown to 2.43% overall, and I have a beta of 0.96. So my overall portfolio beta is very similar to the total market. And a point I want to discuss right away is the current dividend yield in my portfolio coming in at 1.96%. I see it in the comments all the time that many people believe there's no point of dividend investing if your current yield is below 3 or 4%. And right now, the total yield on average in my portfolio sits at 1.96. So I understand this is a very low yield for many dividend investors, but for me personally, it is right where I want to be. I am in my early 20s. I will be investing for at least 3 more decades before I actually need to retire off this dividend income. So right now, I'm picking the companies that I believe will have the ability to grow that income for long into the future. I don't buy any stock to ever sell it. When I buy into a company, I plan to hold for the long term, and I'm talking 10 plus years. So I don't chase yield right now. I'm buying the companies who have the ability to generate growing free cash flow for long into the future and return that cash to me in the form of a growing quarterly dividend. So right now, because I'm so young, there's no need for me to chase yield and buy into the 5, 6, 7, 8% dividend companies that may provide some current cash flow, but lack the total return, and I will actually underperform the market over the long term buying into those high yielding companies. I don't need the current income right now. I'm buying these assets for the long-term capital appreciation and the long-term capital dividend growth as well. So right now, I'm focused on total return while buying dividend growth companies. I believe in dividend companies because I believe the management of a company that pays out a dividend thinks differently, they're a little bit more conservative, they don't take as much risk, and that's what I want for my investments. And I love filling my portfolio with boring companies. I like the brands that can grow revenue and income year after year without any drastic changes to their business. I love the companies who have strong market share in their respective industries and can operate with pricing control over the longer term. And if we just take a look at my holdings, they're all blue chip companies that I'm sure everyone knows and uses on a day-to-day basis, and these are the companies who dominate their respective industry. I don't go for any high growth players who take on a lot of risks. I don't go for any companies who lose money year after year. I go for the profitable, strong, blue chip dividend paying companies that may be considered boring, but they all provide me with some growing passive income quarter after quarter, which is exactly what I want. So overall, I am a boring investor, and I feel proud to say that, and I have no problem having a current yield below 2% because over the long term, my total dividend income will continue to compound, and we can see my dividend growth rate is at around 8.3%, which is pretty high for a diversified portfolio across every different sector. Of course, if you go for only young tech dividend paying companies, your overall dividend growth may be higher, but I have a mixture of some slow growth utility names, some telecoms, financials, consumers, of course, some tech as well. And overall, my average dividend growth CAGR sits at 8.3%, which is absolutely fantastic. And that means if I didn't buy or sell any stocks and none of my companies changed their dividend growth rate, we're expecting this $2,149 to annually annually by around 8.3% going forward over the next few years. And taking a look at my dividend safety, 92% of my overall income is considered likely safe and 8% is considered borderline. And if we take a look at these numbers, only 2 of my dividend paying companies are considered borderline safe, and they are Bank of America and JP Morgan Chase. And right now, I do not consider either of these companies as a borderline safe rating, and I do believe going forward, this platform will upgrade both companies back to a safe rating. And why I believe that is because Bank of America and JP Morgan Chase are in a very strong financial position. We've gotten out of this pandemic in a much better position than where we started, and the banks are in such a healthy financial position right now. The Fed has removed all restrictions on share buybacks and dividend increases. And after the latest stress test, all the major banks were tested for some drastic scenarios. They were forecasting 11% unemployment with a 52% decline in the stock market, and even during that situation, both of these major banks had current capital excess 2 times the required rate. So right now, these companies are in a very, very healthy financial position, and I do believe these dividends are extremely safe going forward. And just earlier this week, we got some major dividend growth coming from both of these companies. Bank of America grew their dividend by 17% starting in Q3 2021, and JP Morgan Chase grew their annual payment from 90 cents per share per quarter up to $1, which represents an 11% increase year over year. So some nice double-digit dividend growth coming from both of these major banks over the past week. So in no way am I worried of a dividend cut coming anytime soon. And both of these mega cap financial institutions have also announced massive share buyback plans over 2021 and 2022, each worth over $10 billion. So going forward, these 2 companies will be buying back a ton of stock, increasing my underlying shareholder value, and have just announced some nice dividend increase, so my quarterly cash flow is growing as well. So I'm not worried about 8% of my income currently considered borderline safe. And of course, 92% is made up of companies who are considered safe or overall very safe. So like we discussed throughout this entire video so far, I am a very conservative dividend growth investor. So now if we take a look at how this portfolio performed throughout June 2021, we can see that I started off the month with a total portfolio value of $102,000, and overall, like we saw it finished, just below $110,000. And in the month, I collected $264 of dividends. I contributed $2,500 of my own capital, and my actual share price of my underlying stocks grew by over $4,400. This was a great month in the market. We were in the green, and taking a look at the S&P 500, it was up around 2.7% over the past month as well. So we can see some nice green on the market, and my portfolio did perform very well. And of course, what I consider my favorite metric for the entire portfolio is the growth of my annual dividend income. So we can see I started the month at $2,044, and I finished the month at that $2,149, like we saw here on Simply Safe Dividends. And my passive income grew by $105 due to a few minor purchases in some random companies throughout the month where I purchased 1 or 2 additional shares, but my biggest buy was I bought 10 more shares of JP Morgan Chase for right around $150 when the stock fell by over 10% in about a week. So I bought the dip on JPM, I added 10 more shares, and of course after the dividend increase, they now pay out $4 per share per year, so that added $40 in my forward dividend income. And of course these dividend increases also bumped up my original dividends from before, which of course helped lead to the growth of my overall annual dividend income going forward. And of course in total, my passivity over a 12-month span grew $105 month over month, which is a terrific sign. And if we take a look, I have a few charts that depict my monthly income starting January 1st, 2021. So of course, these charts only have 6 months worth of data, so they're not very depictive on a long-term trend of the total portfolio growth. But going forward, I plan to update these charts every single month, so over the next year or two, we're going to get more data points and get an accurate trend of the total portfolio growth in terms of passive income and total portfolio value. And of course, taking a look right now at the first 6 months, my monthly dividend income chart does look pretty wonky, and that's because of my sale of AT&T stock. So AT&T, of course, before the dividend cut was a massive yielding company, and my yield on cost was above 7%. So when I sold out of the company a few months ago, that made a drastic change to my total portfolio dividend income, and I did sell before the ex-dividend date, so I did not collect the second payment in the current 2021 calendar year. So overall, we do see some fluctuations month over month, but over the longer term, as I continue to contribute more capital to the portfolio, buy more stocks, I do think this chart will trend upwards in the right direction. And of course, if we take a look, my total portfolio value beginning in 2021 has continued to grow month over month. Of course, I am continuously funding the portfolio with $2,500 per month, which is a lot of capital, and the market's been green to start the year, which has of course helped it grow from the 2020 lows. And if we take a look, the third chart I have is the growth of my annual dividend income. So like we saw, after I sold out of AT&T, that's what led to the major drop in the total passive income forecasted over the next 12 months. But 2 months later, I have been buying more stock, recapitalized the sale of my AT&T position, and now I'm getting that number back up to where it was before when I owned AT&T. And like we saw, $2,149 of my forward 12-month dividend income. So overall, that was an update on my portfolio through the month of June 2021. My biggest buy was of course more JPM stock. We took a look at my dividend income. I explained to you my underlying holdings, my investment philosophy, and the long-term goal of this portfolio is to achieve financial freedom. That's why I have the portfolio named that. So every single time I log on, I make a video, I see it, it's very clear, it's always in my mind, and it helps me make smart investing decisions. Instead of getting FOMO, trying to go for and chase some nice high current yield or some nice growth on a shorter term period, I try to stick to my goal, long-term capital and dividend appreciation to make the best investments possible and build out a nicely diversified portfolio. And of course, before we wrap up the video, I just want to remind you, you can take a look at my portfolio for absolutely free at any time using the link in my description. I have a free Google Sheets platform that allows you to look at all my underlying holdings, my growth on each one, how much dividend income I collect from each company, and overall we can see 3 random individuals are currently on my portfolio. I don't get your names, it's completely anonymous, and of course this is completely free to use and I will never charge you for access to my portfolio. I'm completely transparent, showing all the good and all the bad, and in total I'm only in the red on one single position, which was Taiwan Semi, and I bought this company right near their all-time highs. Do I regret it? Absolutely not. I plan to hold over the long term, and this company owns a lot of key players in the underlying semiconductor industry, so I will hold going forward, and I do think the capital will return and grow over the longer term. So we can see overall, my portfolio is diversified across many different sectors, but tech does make up around 44%, and I'm gonna make it very clear, I do not feel I'm overweight in this sector whatsoever. Of course, tech is a very broad sector nowadays, and I do not believe I'm overweight in any single fashion. Taking a look at all my tech companies, for example, I own Apple and Microsoft, 2 major tech players, the largest 2 companies in the world, and they operate in very different manners. Of course, Apple is a hardware company that's shifting into the software game, and Microsoft pretty much has a completely different business with very different products. So overall, I like owning both of these companies as the number 1 and number 2 position in my total portfolio. And then of course, I own Visa and MasterCard. These 2 companies operate under the tech sector umbrella, but they're completely different than Apple and Microsoft. And of course, owning both of these companies allows me to control more than 70% of the global credit and debit card industry, which absolutely is phenomenal for only owning 2 different stocks. And then of course as well, in the tech sector, I own 3 semiconductor players in Broadcom, Taiwan Semi, and Qualcomm. So overall, although tech makes up a large majority of my portfolio of a total of 44%, by taking a look at the actual stocks that I own, they're very different. Apple, Microsoft, the 2 big players, stocks number 1 and 2 in my portfolio. Of course, exposure to, I'm going to call it the fintech sector through Visa and MasterCard, and then 3 semiconductor plays as well, also considered tech brands, but very different operations. So I get a lot of comments as well saying you're overweight in tech, which I do understand why you're saying that, but if you take a look at my underlying tech companies, they all have very different operations, and I'm not solely focused on only one area of the underlying tech sector. And of course, all my other sectors, I do believe I'm nicely diversified, and I do like the holdings I have in my portfolio at this current point in time, and in no intention of selling any of them anytime soon. So overall, that was kind of a recap of 2 of the most important questions I get in my portfolio. Why am I so concentrated into tech, and why do I have such large positions in both Apple and Microsoft? So overall, now I'm going to wrap up the video. I really appreciate you watching all the way to the end. This was the June update of my financial freedom portfolio. Thank you for watching. Please hit that like button and subscribe. Ask me any comments down below if you want to know anything about my portfolio or my investing goals, and I will see you in tomorrow's video.